Hey, everybody, welcome to Simply Money today. We have a special topic. We're going to talk about assets under management fees, what they are, and how they impact you and your future financial freedom. You probably see this in the fine print. Maybe your financial advisors even talk to you about my fee. It's just a small 1% fee, and it may seem very insignificant, especially when you're starting off. You deposit $1,000 with them to begin, and then you're young and you're beginning to put money in every month. You make these deposits and you're only paying the 1% on that thousand. And you see the statement each month or each quarter, and you see this fee, and you think, well, it's not that much. But the impact that has long term is amazing. And the power of that compounding on you and how it's robbing you from the success and achieving financial freedom. We're going to take a look at that. We're going to give you a couple examples and show you the impact of these fees and a good alternative. So stick around to the end to see what those alternatives are and how you can achieve your financial freedom even quicker by avoiding the AUM, the assets under management. So, what is assets under management? Basically, it's the fee that your financial advisor charges you for every dollar that you have under his management or her management. So, when you deposit, let's say $100,000, you've accumulated this over some years, and you have $100,000 with them, that's the amount of assets under management. And as that grows and you continue to make deposits, that amount, that asset under management amount continues to grow. So each month, it may go up, it may go down as the market is going up and down, but long term, it's growing. And the larger your portfolio becomes, the more assets under management the financial advisor has that you're now paying fees on. Let's talk about budgeting real quick. I want to talk to you about Pocket Guard. With the recurring transactions, it's a great and simple way to set up your budget for recurring bills to take place. Let me show you real quick. When you open up Pocket Guard, go over here to the left and click on Plan. The plan opens up to this page. You can see I've put in some information. We're going to set up recurring bills. Down here, you see it says Edit Section. We're going to add a bill. Add manually up here to the right. And we'll put in the merchant's name. We'll put car dealer. The amount, $500. Frequency, every month. Hopefully you don't have that high of a car payment. But that's another video for another time. It is due on the second day of every month. So we set that up. We want to hit this auto repeat. So it automatically puts it in there for you every month. So one-time setup. We're going to put that under auto and transport for category. You pick the account you want that to come from. I only have the one fake account set up right now. So we'll put that, and then we hit save. As you can see, it added it here. And we can go down. You see I have a phone bill coming up in March. It shows you what's coming up. Simple, fast way to set up recurring transactions. Stay tuned for more videos on Pocket Guard. So we're going to look at some of these. Those assets under management are crucial because every fee they take out is money that's not only earning interest, it's now that interest is an earning interest. That compound impact is taking effect, and it is detrimental to your retirement portfolio, to your investment portfolios. So let's look at the first example. I'm going to throw a chart up here for you to look at and to help see this a little bit more in light. But let's imagine that you've accumulated up to $100,000 in your portfolio. Maybe you rolled it over, maybe you're just starting out, and a few years down the road, you achieve this goal of $100,000. That's nothing to snub your nose at. That's a good way to get started. That 100,000 is the goal to get, because when you hit that, things start snowballing and it grows rapidly. But let's just say we have $100,000 assets under management, and your financial advisor is achieving a 7% return on that. On average, over all the 30 years that you have it under management, 7% 7% return on those assets. And let's just say that your financial advisor, the average is 1%. Most advisors are going to charge you 1% asset under management fee. Some charge more. If they're charging more, you better run. A few charge less, especially if you get a larger portfolio. Usually after you hit $1 million, they'll go down on that asset under management fee because they're still making bank off of you. So they don't care if they drop it a little bit. But 1% is the standard industry average of asset under management fee that you're going to run into. So on that $100,000 with a 7% average return, that's after they've taken out their 1%, you would look at having, after 30 years, your investment would grow to around $574,000. Now, again, that's a great investment. That's a great outcome. But what is the impact that the AUM is having on you, that fee that's being taken out? Do you really see what impact it's had? Let's kind of bump it up a little bit. Let's say you got stuck, you're with somebody that has a 2%. Now, that's really high, and that's probably not going to be found out there very often, but there are some out there that do that. So just 1 more percent fee. Again, you think, 1%, 2%, that's not a high fee. If you had the same $100,000 with a 2% fee, now you're looking at, after 30 years with the same 7% return, the impact of that 2% fee is now your portfolio only has a final balance of $432,194. That's a difference of $140,000 over the course of 30 years because of one additional percent fee. So don't tell me 1% fee doesn't have an impact. That 1% fee on the same exact portfolio would impact approximately $140,000. So let's look at another example. Let's go a little bit lower on the initial startup. Let's say that your assets under management fee is only, let's go with another scenario with a smaller asset under management amount. Let's say we're starting out with $50,000. Same 7% return, same 1% versus 2% AUM fees that we're looking at. So $50,000 would grow over 30 years with a 1% fee to $287,174. But if you had a 2% fee, now you're only growing to $216,000. Again, $70,000 difference after 30 years because of 1% fee. So when you sit down with a financial advisor and they're talking to you about, I have a small 1% fee, don't let them fool you. That 1% can talk about hundreds of thousands of dollars over the course of your investment career. So let's continue to look at this. What impact is this having? So we looked at the impact of the overall portfolio balance, and that's eye-opening. To me, if you're looking at over 30 years, $140,000 lower on your balance, that's a huge difference. That can make or break financial freedom for many people. So that is a huge impact that you have. Let's break it down per year. So let's look at the same scenario. You have a 1% fee and you have $100,000 of assets under management. So that first year, you're going to pay $1,000. That's the cost for them to manage your money, to buy and sell some things and try to, impact your return and get you the best return on your investment possible. Hold on to that thought, because that's what they're selling you on. They're managing what they buy, what they sell, where your money's going, so they can get you the best return possible. There's a statistic I want to show you in a moment, but I want you to really think about this for a second. After they sell you on, I can manage your money and get you a great return, it's only going to cost you a small 1% fee. They've impacted $140,000 on that scenario that we looked at. So now annually, if you look at it, the first year with $100,000 of assets under management, you're only paying $1,000. Again, that's no chump change, but you're like, it's $1,000, but they're going to get me to that financial freedom. They're going to get me the best investment, the best returns. Let's fast forward that with the same 7% return that they have achieved over 30 years. Year 30, with your $700,000 balance, you're going to pay $21,000 in fees. Your AUM, that small 1% fee, is now $21,000. Yep, $21,000 that year that's being taken out of your investments to pay your manager, your financial advisor, for those great picks that buy and that sell and that managing all the stress of what to do for you. That's the fee you're paying. When you're getting ready to retire, that $21,000. Year 2, 3, 4, all the way up to 29, you've been increasing. And now at year 30, you're paying $21,000 annually for them to manage the portfolio. So you can see the significance. At year 30, wouldn't you like to have that 21,000 extra dollars? That's not counting the prior 19 years or 29 years that they've taken those fees that have exponentially grown. So what are the alternatives? I don't know what to invest in. I don't know what stocks to buy. I'm reading this as a good stock, and then a month later it's nosediving. I remember as a kid, hey, Kodak, that was a big company. Sears, those were great companies. These were everyday American name companies that they couldn't fail. They went bankrupt. Big companies fall. So people are scared. I understand stock picking is a scary thing. So what's the alternative? That's why I always encourage people go with low cost index funds. Let's look at an example of this. What an index fund is basically what your financial advisor is doing. He's buying into mutual funds that are managed and you're paying a higher fee, where he's buying individual stocks to make up his own little portfolio and selling and trying to time the market and you're paying that fee of 1%. A low cost index fund takes a group of stocks, puts them in, weighs them on different categories, and every index fund has different priorities and parameters that they use, but they have a group of 100 or 500. Let's use the S&P 500 index fund, SPY, as an example. 500 of the top stocks in the US put into one fund. You pay a low fee of 0.06 or 0.04, depending on the index fund. That's why it's called a low cost index fund. And those groups of stocks are now self-managed because as they fall in value, they reduce the amount that index holds of them. If they increase in value, it increases the amount that index holds. It's all self-managed. You buy, hold, and close the book. You don't have to do anything with it. Index funds are great for buy, hold until you're ready to retire. And then you can either transfer them into dividend funds, bond funds, other things. But the big thing is for those 30 years, you're not worrying about it. And let's see the difference in the impact on your investment. So let's use that same example of $100,000 that you buy into an S&P 500 index fund. Let's say it only averages 7%, which is way lower than it's averaged. And you're paying the 0.2% fee after 30 years. Your balance is now $761,000. So compare that to the 574 or the 432,000 you would have had in a managed fund charging 1 or 2%. You're talking $200,000 more. And all you had to do was invest it into an index fund, leave it alone, and go about your life. And when you come back, when you're older, that fund has done all the work for you. Index funds are hands off. They're so easy. And their accumulation of wealth is greater. And we used a 7% on an S&P 500. They're more typically around 10%, sometimes 12%. You consider that, it is amazing the impact it has. So let's look at one more low cost index fund example. Let's go with the $50,000 investment. You invest $50,000 and it's earning 7% interest on a low cost index fund of a 0.2% over 30 years. And now you've accumulated approximately $380,000 versus the 287 or 216,000 with the 1 and 2% AUM fees that your manager has. Again, that's over $100,000 more simply by not having someone manage it. And I know there's going to be those people that think, but a managed fund, they'll do better. Actively managed, they're going to buy and sell better timing. 80% of index funds outperform mutual funds and managed funds. That's right. Take index funds, take mutual funds, managed funds. 80% of the time, index funds outperforms. So not only are you not paying a fee, you're outperforming. Because if the S&P 500 has a 10% return, your financial advisor needs to get 11% just to break even. They have to outperform because of the fee they're charging for you to make the same amount. That's why I encourage people all the time. Assets under management fees will kill you. Look at index funds. They're the great, safe way. They're diversified, so you're not putting all your eggs in one basket. They're low maintenance, they're low fees, and they accelerate your compound interest. If you have questions on what index funds, I have some videos you can check out on what they are, how they work, a little bit more deep dive into them, what some of the terms mean. But for those of you that understand what they are, but you've just been like, well, I think I need to have a financial advisor. If you're dead set that you need a financial advisor, I encourage you to find one and pay them for consultation, a set fee. Maybe it's $100 an hour. You check in with them once a year, whatever the case may be. Do something that you have more control over the costs that they are getting, because the 1% AUM is going to destroy your potential to grow your portfolio. That's it for today's video. Thanks for joining me. Don't forget to hit the like and subscribe button. We'll see you next time on Simply Money.